Imagine a pharmaceutical empire that discovers no new cures, invents no breakthrough treatments, and spends virtually nothing on research, yet somehow becomes the most valuable company in its nation. This is not a hypothetical scenario. In the summer of 2015, Valeant Pharmaceuticals achieved exactly this impossible paradox. Wall Street hailed it as a revolutionary business model, rewarding the company with a staggering market capitalization of nearly $90 billion. But behind the soaring stock price and the breathless analyst upgrades lay a labyrinthine architecture of deception. This was a financial illusion built on the backs of captive patients, extortionate drug pricing, and a phantom network of hidden pharmacies. The collapse of this empire would not only erase billions in wealth, but also expose the dark, beating heart of modern corporate healthcare. To understand the magnitude of the deception, one must first examine the engine of Valeant's explosive growth, the roll-up strategy. In corporate finance, a roll-up strategy involves a company aggressively acquiring multiple smaller firms in the same market to consolidate the industry/operating costs and rapidly increase revenue. Under the leadership of its ambitious executives, Valeant perfected this method, weaponizing it against the traditional pharmaceutical model. Instead of investing billions into the uncertain, decades-long process of developing new medications, Valeant simply bought the rights to drugs that were already indispensable. They targeted niche, life-saving medications for which patients had no alternative, effectively cornering captive markets. Once the ink dried on an acquisition, the true nature of the strategy was unleashed. Valeant systematically and ruthlessly hiked the prices of these acquired drugs, often overnight. The increases were not marginal adjustments for inflation. They were astronomical multipliers. Medications for rare conditions saw their prices skyrocket by thousands of percent. A drug that once cost hundreds of dollars suddenly cost tens of thousands. The company's internal calculus was chillingly simple. Because these drugs were essential for survival, insurers would have no choice but to pay the extortionate rates, and patients would have no choice but to endure the financial devastation. However, this predatory model possessed a fatal vulnerability. The broader healthcare ecosystem is not entirely defenseless. Pharmacy benefit managers and health insurance conglomerates eventually recognized the catastrophic drain on their resources. These institutions began to push back, implementing strict authorization requirements and forcing patients toward cheaper generic alternatives whenever possible. The insurers erected bureaucratic walls to block Valeant's artificially inflated claims. For a company entirely dependent on continuous exponential revenue growth to justify its massive debt load, this resistance was an existential threat. The roll-up machinery was seizing up, starved of the cash flow required to fund the next acquisition. Confronted with this systemic blockade, Valeant did not lower its prices or negotiate with insurers. Instead, it circumvented the entire system. The company required a mechanism to bypass the gatekeepers, a conduit that would guarantee its expensive drugs flowed directly to patients, evading the scrutiny of insurance auditors. This necessity birthed one of the most audacious corporate partnerships in modern medical history. Enter Philidor Rx Services, a seemingly independent specialty pharmacy based in Pennsylvania. On paper, Filidor was just another distributor in the vast pharmaceutical supply chain. In reality, it was the hidden engine of Valeant's continued deception. Filidor functioned as a captive distribution network, a financial black site designed to launder Valeant's aggressive pricing strategy. When a doctor prescribed a Valeant medication, the prescription was often routed directly to Filidor. The pharmacy's primary directive was to ensure the high-priced Valeant drug was dispensed and billed, regardless of whether a cheaper generic was available or preferred by the insurer. To achieve this, Filidor employees allegedly engaged in highly questionable and in some cases fraudulent practices. They utilized aggressive tactics to secure insurance approvals, essentially wearing down the administrative defenses of the healthcare system through sheer volume and persistence. The mechanics of this operation were startling in their brazenness. Investigations later revealed that workers at Filidor were instructed to alter prescription codes. If a physician did not specifically mandate a brand-name drug, pharmacists are typically required to dispense the generic version. To circumvent this, Filidor employees reportedly manipulated the dispense's written codes on prescriptions, forging the physician's directive to ensure the expensive Valeant product was billed. Furthermore, they utilized a backdoor network of phantom pharmacies. When an insurer blocked Filidor from its network due to suspicious billing patterns, Filidor simply routed the claims through other, seemingly unrelated pharmacies that it secretly controlled, masking the true origin of the transaction. The most sophisticated layer of this deception, however, was the financial architecture that bound the two entities together. Valeant went to extraordinary lengths to hide its true relationship with Filidor from investors and regulators. They utilized a complex accounting structure known as a variable interest entity. A variable interest entity is a legal business structure in which an investor holds a controlling interest, despite not possessing a majority of the voting rights, often used to keep certain assets or liabilities off the main corporate balance sheet. Valeant had paid $100 million for an option to acquire Filidor, effectively securing total control over the pharmacy's operations and financial destiny. Yet because it was technically an option to buy rather than an outright purchase, Valeant did not consolidate Filidor into its public financial statements in a transparent manner. This deliberate obfuscation allowed Valeant to maintain the illusion of independence. When investors looked at Valeant's soaring revenue figures, they saw what appeared to be organic, market-driven demand for its products. They did not see that Valeant was essentially selling drugs to itself, stuffing the channel through a captive pharmacy that it secretly controlled, and using that captive pharmacy to strong-arm insurers into paying inflated prices. The revenue was a mirage, artificially pumped through a hidden, closed-loop system. The company was booking sales the moment products were delivered to Filidor, long before they ever reached a patient or were paid for by an insurance company. While Wall Street celebrated the unprecedented financial returns, the human cost of this closed-loop system was quietly mounting. Patients found themselves trapped in a labyrinth of automated refills and aggressive copay assistance programs designed to blind them to the true cost of their medications. By covering the patient's out-of-pocket copay, Filidor ensured the patient had no incentive to question the underlying price of the drug, leaving the insurance company to shoulder the burden of a $10,000 bill. This artificial inflation inevitably bled back into the broader economy, driving up insurance premiums and draining resources from a healthcare system already strained to the breaking point. The victims were not just the patients who required these life-saving drugs, but every participant in the medical economy. The illusion held until the autumn of 2015. The political climate surrounding pharmaceutical pricing was undergoing a seismic shift. The public outcry over predatory drug pricing had reached a boiling point, drawing the intense scrutiny of lawmakers and investigative journalists. The spotlight, initially focused on other bad actors in the industry, inevitably swept over Valeant's staggering price hikes. As congressional subpoenas were drafted and political rhetoric sharpened, the foundational premise of the roll-up strategy began to fracture. The assumption that prices could be raised infinitely without consequence was suddenly subjected to the harsh light of national outrage. It was in this volatile environment that the hidden architecture of Filidor was finally exposed. The catalyst was a specialized breed of financial investigator, the short seller. A short seller is an investor who borrows shares of a stock and sells them, betting that the company's price will fall so they can buy the shares back at a lower price and profit from the decline. Driven by the financial incentive of uncovering corporate fraud, an investigative research firm named Citron Research published a devastating report. The report asked a single explosive question: was Valeant operating a massive network of phantom pharmacies to create fake sales? Citron explicitly compared the pharmaceutical giant to the most notorious financial fraud of the early 2000s, asking if this was the pharmaceutical Enron. The publication of the short seller report triggered a catastrophic chain reaction. The market's blind faith in Valeant evaporated overnight. Independent investigative journalists and forensic accountants descended upon the company's public filings, tearing away the veil of the variable interest entity. They traced the digital footprints, uncovering the tangled web of alternative pharmacy identification numbers and the aggressive prescription-altering tactics. The sheer scale of the Filidor operation and the extent to which Valeant's revenue depended upon it was laid bare for the world to see. The secret was out, and the financial gravity could no longer be defied. The financial reckoning was swift and brutal. As the depth of the deception became undeniable, major pharmacy benefit managers severed all ties with Filidor, instantly suffocating Valeant's hidden distribution channel. Without its secret engine, the artificial revenue streams collapsed. Valeant's stock price, which had touched the stratosphere just months prior, entered a terminal free fall. Within a matter of weeks, tens of billions of dollars in market capitalization were incinerated. The darling of Wall Street had become a toxic pariah, its business model fundamentally broken by the sudden enforcement of transparency. The fallout extended far beyond the trading floor. The Securities and Exchange Commission launched a sweeping investigation into the company's accounting practices and its failure to adequately disclose the Filidor relationship. Valeant was forced to restate its earnings, admitting that it had improperly recognized nearly $58 million in revenue. The architects of the roll-up strategy were ousted in disgrace, leaving behind a hollowed-out corporate shell burdened by over $30 billion in debt. Several former executives associated with Filidor faced federal criminal charges, eventually resulting in convictions for orchestrating a multi-million-dollar kickback scheme. Yet, examining the anatomy of this scandal reveals a deeply unsettling truth about the systemic vulnerabilities of the financial markets. For years, the most sophisticated institutional investors, auditors, and analysts on Wall Street had enthusiastically funded and defended Valeant's operations. They had ignored the glaring red flags. The lack of research and development, the predatory price hikes, and the opaque financial disclosures were all overlooked because the quarterly returns were simply too lucrative to question. The ecosystem of corporate finance was entirely complicit, incentivized to look the other way as long as the stock price continued its upward trajectory. In a desperate bid to survive the wreckage, the company embarked on a massive rebranding effort. Seeking to erase the profound stigma attached to its history, Valeant Pharmaceuticals officially changed its name to Bausch Health. It was an attempt to bury the past, to sever the linguistic ties to the Filidor scandal, and to re-enter the market as a reformed entity. But a change of corporate signage cannot rewrite the historical record. The towering debt remained, a heavy anchor forged during the years of reckless acquisition and financial engineering, permanently restricting the company's future. The Valeant Pharmaceuticals and Philidor Rx Services scandal remains a definitive masterclass in corporate malfeasance. It stands as a stark warning about the dangers of a financialized healthcare system where the pursuit of infinite growth supersedes the fundamental obligation to patient welfare. The deception was not merely an accounting error, it was a deliberate systemic exploitation of the sick and the vulnerable, masked by the sophisticated jargon of variable interest entities and aggressive corporate strategies. As long as the market rewards financial manipulation over genuine innovation, the shadow of this intricate deception will continue to loom over the intersection of medicine and money.